What's up guys, Jake here. In today's video, we're going to do another update to my brokerage account challenge. In the event you haven't seen any of my prior videos, I will include the playlist down below so you can catch up. And it is me versus that total stock market index fund. And the positions in this video are current as of March 25th. This is day 57 of 252 trading days on the year. And the market has passed the 1 year point of bottoming out. I think it bottomed out last year on March 23rd because of the pandemic. And just look at the S&P. Look at what it's done over the last 12 months. It's basically up 76%. So the takeaway here is that if you're a total stock market investor, if you had just ignored that dip and held for the entire year, you'd be up significantly. Additionally, if you somehow timed the market correctly and sold out as the market was falling, and then was smart enough to buy back in around here, you'd have huge gains for the year. I know in every video I say, oh, we're going to hit 4,000 for the S&P, but we've been struggling. You know, it's been almost a month, and we just keep hovering in the 3,900 to 3,950 range, and the S&P can't quite get to 4,000. So the total stock market index fund is up 5.76% or $1.44. And I am up about $8,971 or 35.88%. For the first month or so, it was neck and neck between me and this index fund. However, once I got the hang of buying call contracts, my account balance has gone up significantly in the last 2 to 3 weeks. So we're going to talk about that. These are my positions as of my last update video from March 17th. You can pause the video if you want to look at what they were last week. And this is what it has changed to. So not a lot of changes. You know, when purchasing call contracts that expire 3 to 6 months in the future, I don't really have to do a lot day to day. I actually prefer this. This is a much slower tempo trading challenge now because I'm not constantly trying to squeeze these 3 to 5% movements in the market day to day. When I buy a call contract, I'm more looking for a trend that should develop over weeks or months potentially, rather than just trying to react to the fluctuations in the market day to day. These are the rest of the positions, and I think I'm holding about 12 call contracts currently. I don't have any put contracts sold, and I do want to do this. I will sell some put contracts relatively soon. However, I'm looking for a spike in the VIX. I'm looking for there to be an event that triggers some volatility. Maybe the market takes a dip. That's a good time to sell put contracts. So I'm going to give it another week potentially. But right now the market's been actually very calm and the VIX has been down. So that's actually a good time to be buying call contracts. And something I want you to notice is that I had a really good day yesterday. I was up 6.38% in one day. Every stock, every position that I was holding was green. So when you look at the day change, everything was green yesterday. So that feels good, and hopefully that can continue. Since my last video, I only made one sale, and that was a call contract on Target. Target actually is in an uptrend, but it looks like since January 1st, it's been trading sideways. So as soon as it got back to this 190 level, I didn't want to hold this call contract anymore. Now, I'm not saying Target's not good and it doesn't have potential upside in the event that you're holding Target, but I am trying to transition away from buying the dip. You know, I bought the call contract somewhere around here. I don't want to just react to stocks going down. I'd rather find charts with good fundamentals that are clearly now in an uptrend and then just hold on to them for a couple months. So Target could be good. It is uptrending. However, I feel like there's going to be some strong resistance around this $200 mark. So I thought it'd be better to just take some profit and then find other positions to allocate this money to. So I bought to open this call contract on Target for $1,250, and I sold to close it for $1,994 for a very nice gain of $743. Once again, if you want to see my Excel spreadsheet from all my trades since January 1st, here are the stock swings in and out of positions versus the call contracts plus the covered call on Xerox plus the sold puts. And my options trading has now exceeded my stock trading. I've locked in a profit of 2,300 from the options trades versus just 2,100 for the stock swings. Okay, now in the last couple of videos, I've touched on the fact that I think that there's a rotation occurring out of tech and growth stocks into cyclical and value stocks. If you were putting your money in a tech stock or a growth stock last year, you could not lose money. However, that is not happening this year. The tech stocks and the growth stocks aren't doing as well. And the reason why I argue is because as investors hit that 1-year mark on getting favorable long-term capital gains, they want to sell off some of their position in the tech and growth stocks and reallocate it to the cyclical and value stocks that are currently uptrending. So how do we catch this? How do we make money off of this event? And something that I like to do that I want to share with you guys is to check out Vanguard's sector ETFs. So if you Google Vanguard ETF, I'm going to show you what you can look at on Vanguard's website. Now, I like Vanguard's list of ETFs because it's very easy to sort and then look at Vanguard's positions and holdings. So if you look at their list of ETFs, it's going to be by asset class. There's 75 of them. Let's scroll all the way to the bottom, and then at the bottom you can see their sector ETFs. This is what the stock market is kind of divided into: consumer discretionary, information technology, materials, healthcare, industrials, financials. And you can sort these. Let's go to 5-year just to get a zoomed out picture of how the sectors have done over the last 5 years. All of these sector ETFs from Vanguard were created in 2004 at about the same time, which is great because you can then compare the sectors and their performances using Vanguard's website. So information technology over the last 5 years has averaged 30% a year. Holy cow. Over the last 10 years, it's averaged 19. Consumer discretionary over the last 5 years has averaged 21 a year. The 1 year is 64. And then we have financials, healthcare, industrials. However, let's now sort year to date. This year, 2021, how have these stocks been doing? And the worst performing sector is information technology. If you had just bought this sector ETF on January 1st, you'd be down 1.23%. However, look at some of these other sectors. Energy up 32, although I don't like messing around with the energy stocks given what's going on in the world. But financials up 15% year to date. So it's currently March 25th in this video, and financials in 3 months is up 15%. Industrials up 9.36%. Materials up 8.31%. So since about January 1st, this rotation has been occurring. If we look at the performance of these sector ETFs, here is information technology. From April 1st of last year to December 31st, they were up 75%. They were the king last year. Think Tesla, Zoom, Apple, Microsoft, Amazon. The other sectors did well from their bottoming out on April 1st. So industrials was up 61%. And financials was a laggard, only gaining 53% from its low on April 1st. But once again, since January 1st, financials up 17%, industrials up 13%, technology only up 1.78%. The reason why is because tech stocks were overbought last year, and the value, when you look at the fundamentals, it's more right now with the financial and the industrials. So people are selling off their tech stocks once they hit that 1 year mark, and they're buying the industrials and the financials. So let me now tell you the 2 new positions that I opened with call contracts, and number 1 is Wells Fargo, and Wells Fargo has a bad reputation. Let's just be honest. There's a lot of people that do not like Wells Fargo because of some of the ethical quandaries that some of their representatives have done, opening credit cards or service accounts without the permission of their customers. So Wells Fargo's been in a lot of trouble. However, their stock was down huge, and it's the last one of the financials to be recovering. And let's just go ahead and look at Wells Fargo's financials, the fundamentals, because it's really not that bad. This is the website Macro Trends. I always use this because it's free, and they show visuals very well on this website. So when we look at the last couple quarters, this is their revenue and sales. It has been down because interest rates have bottomed out. However, anybody who's investing in the financials right now sees a recovery as interest rates inevitably have to rise again. So I'm not too concerned by the revenue dip. Same thing with net income and their profitability. Obviously, this is down huge. But what I do like about Wells Fargo is shares outstanding. After the 2008 financial crisis, they issued a lot of stock. However, they've been pretty consistent in buying back shares, and as soon as I think they're legally allowed to, they probably will resume buying shares, but I don't see them issuing new shares. When we look at the price ratios, once again, these are going to be a little off, but Wells Fargo, their price to free cash flow has always been averaging around this 8, 9, 10, 11. It's obviously shot up huge because, once again, their revenue has been hit by interest rates dropping. But if you're buying this stock for future growth next year or the year after, Wells Fargo should recover nicely. However, what I like most about Wells Fargo is their technicals and the clear upward trends. They had a Golden Cross event a couple months ago. It's now clearly upward trending, and it's nowhere near to where it was pre-pandemic. I think their share price was closer to 50 or 60. So the call contracts that I bought on Wells Fargo expire on July 16th. I paid $281, so the premium is $2.81. Add that to the strike price, and my break even is $42.81. So Wells Fargo has to get to $42.81 by July 16th for this contract to be in the money. However, I probably will sell it prior to 30 days out. So that was a call contract that I bought on a financial stock that I felt like had been lagging behind the other big banks. The other call contract I bought this week was a defense contractor. The defense contract stocks have been lagging behind the industrials. Once again, their fundamentals are good, but I think because of the election and news and perception of Democrats having power, it's not as good for the defense stocks. However, there's so much money in the market that people are looking for deals. They're looking for the most undervalued stocks to secure their money because everything else is so overvalued at the moment. So I was looking at defense contractors, and I just Googled defense contractors. These are the 10 largest, and I'm already in Huntington Ingalls. I found them 2 months ago, and I like their fundamentals, and they're now uptrending, so I got back in that stock with a call contract. I also really like Northrop Grumman, and I like Lockheed Martin. However, for this video, I bought a call contract on a company called General Dynamics. So when we look at the stock graph for General Dynamics, it didn't really have a Golden Cross event. It just had been trading sideways for a really long time, probably since the pandemic last March. And it's now had a breakout. It's punched through whatever resistance line it was stuck at, like 155. It's now on a clear upward trend, already up to 180.66. So let's go ahead and look at the fundamentals for General Dynamics. So when we look at the total revenue for General Dynamics, it's been on a clear upward trend, especially since 2016. And when we look at their net income, once again, solid earnings for the longest time. And let's go to shares outstanding. This is one of my favorite things. They've been aggressively buying back shares the last decade. They probably will continue once we're in the clear. When we look at price ratios, this is how you can determine if the company is undervalued compared to where it's been historically. And historically, their PE has been between 15, 16, 20, and it's currently at 16. So compared to where their price to earnings ratio was in 2017, it has not recovered. It's still not back to where it was. When we look at price to free cash flow, it's way down. So this company's price to free cash flow was valued around 35, 27, 28, and it's currently only at 17. So I bought a call contract that expires August 20th. It cost me $1,350, the strike price of $180. This chart is actually from today, and I bought this call contract yesterday, so it's already in the money by 66 cents. However, my break-even price, you add the premium of $13.50 to the strike price of $180. It needs to get to $193.50 by August 20th to expire in the money. However, I'm really liking the uptrend that I'm seeing right here. All the industrials the last 2 or 3 months have had stock charts that basically look like this. So if you're looking for a good sector to buy right now to capture these uptrends, the industrials, in my opinion, are the best option right now. So here are all the call contracts that I currently own, and I have 2 different kinds. I talked about this in my last video, but I have calls on stocks that are currently down from their all-time high: Costco, Apple, Walmart, Dollar General, and Verizon. And then I have call contracts on these stocks which are currently uptrending. They're at a local high. And of these 2, I'm more now I'm preferring the buying call contracts on stocks that are clearly in an uptrend. The chart, it might be negative 1, 2, or 3 days in a row, but it's having higher highs and higher lows in the short term. So it's a bullish stock chart. So for the stocks that are currently down, I've set prices or dates that I want to get out of this call contract. And these prices are resistance lines on the charts where I think the stock might have trouble getting past it. Whereas with these, I just want to hold it. I want to hold it until it's clearly obvious from the stock chart that the uptrend has been halted. Now, what could cause this? Could be a newsworthy event, or the stock just starts looking overpriced, overvalued, which is why I'm trying to find and favor stocks that have good fundamentals. They look undervalued compared to the rest of the market, or compared to their previous past years' valuations. So I'm looking to exit these positions at around these prices, and I just want to keep buying uptrending call contracts. This has been working really well for me the last 2 weeks. So let's see if I can keep it going. Okay guys, if you enjoyed this video, give me a thumbs up so the algorithm knows it's good. In addition, if you have any comments or questions about anything that I do in these videos, go ahead and leave me one down below. I will help you if I can. Until the next video, take care.